this video, I'm going to show you the top 15 phrases to know in a 1031 exchange. Remember, a 1031 exchange is when you sell one investment property and you buy another one with very specific rules and timetables. And you can defer taxes, possibly forever. What are the top 15 phrases to know in a 1031 exchange? Number 1, IRC 1031. IRC stands for Internal Revenue Code 1031. Sometimes we call it IRS 1031, but of course that means Internal Revenue Service. Number 2, real property. Real property has to do with real estate. It has to include the earth. It can be anything from a high building to a farm, but it has to be related to the earth. Held for investment. It's important in the code of the 1031. It means that your intent is to hold it for investment as opposed to flip it, to live in it, that kind of thing. So you need to show that you've held it for investment for at least 2 years. That's what they expect as a definition. Equity. What is equity? Equity is defined as your value minus your loans. Basis. This is an accounting term, and it really is more or less what you paid for it plus the cost of any improvements you've made. Gain. Your gain is also an accounting term, and that's what you're going to be taxed on. And essentially, it is your sales price less closing costs minus your basis. That's why basis is so important. Capital gains tax. That's the tax that you pay on your gain if you've held the property over a year, and it is super important because if you sell the property, you're going to pay a capital gains tax. If you exchange, it gets deferred, sometimes forever. Like kind. That's a term in 1031 exchanges, and it means a property that you can exchange into. And that may not look at all like the property that you are selling. You might be selling a house or an office building, and you might be buying something like a farm or a condo or an oil lease. Depreciation. Again, in this situation, it's an accounting term, and the IRS will take it off your property value, whether you put it on your tax returns or not. And it's actually a paper loss that makes you more money each year in your investment. And you can only depreciate improvements. You can't depreciate land. Depreciation recapture. Guess what? When the government lets you have a benefit, it takes it away if you sell. And when you sell, any depreciation that you took or didn't take that you deserved will be taxed at 25%. That's a really big reason to do a 1031 exchange. Number 11, relinquish properties. This is sometimes called a down leg, and it's the property you sell. 12, acquisition property, sometimes called an up leg, and that's the property you buy. Qualified intermediary, that's who holds your money. They better have deep pockets, be very reliable. Usually an entity like a title company auxiliary. Designated property. This is the property that you tell the qualified intermediary that you intend to buy. Boot. Boot is any cash or things of value that you take in your exchange that is not given to the qualified intermediary for your next property. Usually money, but it could be jewelry, diamonds, and something that has to do with the apartment. It could be a variety of things. Most likely it's money. Oh, and if we haven't met, my name is Maxine Golden, and I'll see you in the next video.